Thank you for joining me this Friday, the 3rd of March. I'm Grady, market analyst with Bell Direct. This is the weekly market update. As inflation remains stubbornly high around the world and investor sentiment is centred around tightening monetary policy globally, it is more difficult navigating the risk levels of investing in different asset classes as we move further into 2023. So let's take a look at what's going on right now and where the investment opportunities may lie. Currently faced with an unusual situation, with investors contemplating the risk of investing into the equity markets in the US, which are currently yielding around 2%, against the lower risk income play of buying into US one-year treasuries with a current yield of 5%. The traditional equity risk premium is not as obvious in the US equities as inflation fuels uncertainty, and this is making equities less attractive than other asset classes. Time will tell, though, if this dynamic points to an equity market correction as investors demand higher yields from stocks. For the year, the ASX is up 3.01%, around 7,250 points, largely due to investors piling into companies like the banks, which benefit from boosted margins pushing earnings higher with every rate hike announced. But while a recession still looms, just how far can the key index go? Taking a look into sector performance this year so far, amidst the high inflation and a rising interest rate environment, there are some key sectors that are thriving through the tough market conditions. Material stocks are seeing the light at the end of the COVID tunnel amid China's reopening and ramping up of demand for key commodities like iron ore and oil. This week we saw China release its official Purchasing Managers Index data for February, showing a rise to 52.6 points in February, the highest since April 2012. In a sign the world's second largest economy is beginning to ramp up manufacturing and overall operations following the removal of its harsh COVID restrictions. The materials sector is up 6.2% year to date, with leaders like BHP up 26%, Rio Tinto up 37%, and Fortescue Metals Group up over 33% over the last 6 months. Technology stocks are feeling some much needed relief in 2023, with the sector up 6.3% year to date and more than 1% over the last month, as investors regain appetite for sharply sold off growth stocks this year. With the majority of stocks trading at a heavy discount in this sector, investors see easing interest rates as a positive for technology companies that have a high growth outlook, as the cost of funding such growth becomes more affordable with every eased rate hike. We have also seen investors favour technology companies that provide an essential service in the current environment, with WiseTech Global leading the charge, up more than 34% over the last year amid the supply chain and logistics challenges the world faced during the pandemic easing. On Tuesday next week, we will gain an insight into how the RBA responds to inflation still sitting at 7.8% in Australia, which is still well above the target range of 2 to 3%. The monetary policy meeting for March has markets betting the RBA will announce another 25 basis point interest rate hike, which will take the nation's cash rate to 3.6%. With the RBA expecting 23% of all Aussie home loans, worth almost $500 billion, set to turn from fixed to variable rate by the end of 2023, the rising interest rate environment will begin to inflict more pain on this 23% of Aussie homeowners. So what does all of this information mean for you and in your portfolio? It's time to await the decision out of the RBA on Tuesday and identify the areas in your portfolio that may be negatively impacted by yet another rate hike. It might be time to consolidate and rebalance into sectors that perform well in the rising interest rate environment. Locally, from Monday to Thursday, on the key index, energy and materials stocks were the only two sectors that closed in positive territory for the week amid rising commodity prices and outlook boosted by favourable manufacturing data out of China as the country ramps up activity post-pandemic. The winning stocks on the ASX 200 were led by gold miners, including Ramelius Resources jumping almost 13%, despite no price-sensitive news out of the gold miner for the week. De Grey Mining added 12.41% and Perseus Mining jumped 10.31%. On the losing end, InvoCare fell almost 19% as investors responded to the funeral company's full-year results, including a loss of $1.8 million. Downer EDI also fell out of favour with investors this week, tumbling 17% after releasing disappointing first-half results, and Harvey Norman also lost 11% on the weaker than expected first-half results. Taking a look at the All Ords, Cogstate led the charge, rocketing over 31% on strong first-half results, while Avita Medical added nearly 24% and Main Pharma rallied 22%. Pointera tanked almost 40% this week after releasing first-half results. The most traded stocks by Bell Direct clients from Monday to Thursday were Megaport, Downer EDI, IGO, Newcrest Mining, Champion Iron, BHP and South32. Clients also bought into ANZ while taking profits from Fortescue Metals Group and Rio Tinto. On the ETF front, we saw the most trading in Vanguard Australian Property Securities Index ETF, Vanguard Australian Shares Index ETF, and BetaShares US Equity Strong Bear Hedge Fund ETF. Investors this week have been most interested in portfolios of diversified Australian property securities and Australian shares, and trading an ETF that allows investors to profit from a fall in the largest 500 US companies. And it's a big week on the economic data front next week. Australia's trade balance data for January is out on Tuesday, giving an insight into whether the country's imports continued outweighing exports for another month, or if China's reopening helped boost exports to a higher trade surplus. The RBA's rate decision for March is also out on Tuesday, with the market expecting another 25 basis point rate hike to be announced. And over in the US, balance of trade data for January is out on Thursday, with a consensus expectation for an increase in trade deficit to $68.8 billion US dollars. US unemployment rate data for February is also out next Saturday morning Australian time, with a consensus for a rise in unemployment to 3.5% in February, up from 3.4% in January. And that's all we have time for today. Have a wonderful Friday and happy investing.